Imagine this, a Freaky Friday moment. You wake up, it's 2026, your bank account is at zero, your investments are gone, and you have to start completely from scratch. Sounds terrifying, right? But here's the thing. If I still had everything I know now, I wouldn't be scared at all. I'd actually have a massive advantage. Because when I made my very first investment, I didn't have that advantage. I wasted months researching random stocks, chasing whatever was hyped up on social media, trying to guess which company was about to explode. It took me years to figure out what I'm about to tell you in the next 13 minutes. Investing doesn't have to be complicated. It just has to be consistent. So today, I'm going to walk you through exactly how I'd start from zero in 2026, step by step, to build real wealth faster and with way less stress. Saving versus investing. Let's set the scene. It's the start of a new year. You've worked hard, cut back on some things, and you've managed to save $1,200. Now you've got a decision to make. Do you save it or do you invest it? Before you answer, let's look at what's actually happening with your money in 2026. Inflation in the US averaged around 2.7% in 2025 and is projected to sit around 3% this year. What that means in real terms, if you're spending $3,400 a month right now, that could creep up to about $3,500 by next year. It doesn't feel dramatic month to month, but over time, it adds up in a big way. So what happens if you just keep that $1,200 in cash? The coffee you're buying for $4 in January might cost $4.12 by December. But the $1,200 sitting in your drawer is still $1,200. You haven't lost money on paper, but in terms of what it can actually buy you, you have. That's inflation quietly eating away at your savings. What if you put it in a high-yield savings account? Right now, those are offering somewhere between 3 and 5% interest. Your $1,200 becomes roughly $1,254 after a year. That's genuinely better. It keeps you ahead of inflation, but it's still not a wealth-building tool. Here's the core difference. When you save, the bank uses your money to lend to other people and pays you a small cut for it. When you invest, you become a part owner of a business. You grow when that business grows. Take Apple. If you'd bought one share back in 2010 for about $10, that same share would be worth over $200 today, not even counting the dividends. That's a 20x return. No savings account can touch that. The stock market has historically returned around 7 to 10% annually over the long term, even after accounting for the inevitable ups and downs. Saving protects your money from inflation. Investing is what actually builds wealth.
Why not just pick stocks? So you want to invest, great, but does that mean you should just start picking individual companies to put your money into? Here's where a lot of beginners, including me, go wrong. When I first started, I spent hours watching videos, reading business news, studying new companies, thinking I was being smart. What I was actually doing was making things more complicated and way riskier than they needed to be. Here's the problem with picking individual stocks. If you put all your money into one company and it fails, you lose everything. And companies fail more often than you think. Take Palm. In the same era that Apple was dominating smartphones, Palm came out with this concept of a small companion phone that would pair with your regular device. Honestly, it didn't sound that crazy. Even Bono, yes, that Bono, invested $460 million into the idea. But Palm couldn't compete with Apple and Samsung. By 2010, they were sold to HP for about $1.2 billion, a fraction of what early investors had hoped for. And within a few years, the brand was completely gone. This is exactly why I moved away from individual stocks and started focusing on something much simpler. ETFs, the smarter starting point. Let me introduce you to ETFs, exchange-traded funds. An ETF is essentially a basket of stocks built by an investment company like Vanguard or Schwab. Instead of buying into one company, you're buying a small piece of hundreds of companies all at once. One of the most well-known examples is SPYM, formerly called SPLG, which tracks the S&P 500. The S&P 500 is made up of the 500 largest publicly traded companies in the United States: Apple, Microsoft, Amazon, and so on. When you buy into that ETF, two really important things happen. First, your risk drops significantly because you're not depending on any single company to succeed. Second, you save an enormous amount of time because you don't have to constantly research or monitor individual stocks. Other popular ETFs include VOO, SPY, IVV, and QQQ. If you're just getting started, I generally recommend sticking with something that tracks the S&P 500. It gives you broad exposure to large, stable, well-established companies that have delivered consistent long-term growth. Personally, if I were starting today, I'd invest in either SPYM or QQQM. I like QQQM because it focuses on the NASDAQ 100, which is heavily weighted toward innovative tech companies. But honestly, either one is a solid starting point.
Opening your first brokerage account. All right, so now you know what to invest in and roughly how much to put in. The final step is actually doing it, which starts with opening a brokerage account. This is just the platform that lets you buy and sell investments. I personally use Fidelity, so I'll walk you through it as an example. Go to Fidelity's website and click Open an Account. You'll fill in your name, address, social security number, and contact info. Brokerages are legally required to verify your identity and report your investment income to the IRS. This is completely standard. Then you'll choose your account type. For beginners, you're mainly looking at two options: a Roth IRA or a taxable brokerage account. A Roth IRA is an individual retirement account. You contribute money that's already been taxed, it grows tax-free inside the account, and when you withdraw it at age 59 and a half, you pay 0 taxes on it, including all the growth. For 2026, the contribution limit is expected to be around $7,500 if you're under 50 and $8,600 if you're 50 or older. Double-check the latest numbers on irs.gov since these can change. A taxable brokerage account has no contribution limit and no restrictions on when you can withdraw. The trade-off is that you'll owe taxes on any profits or dividends you earn. For this walkthrough, I'm going with the Roth IRA because of the long-term tax advantage. Once your account is open, head to your dashboard and click Transfer to link your bank and deposit your money. Think of the Roth IRA as your shopping cart and the ETFs you're buying as the items you're placing inside it. After your funds are in, go to the Search or Quote section and look up the ETF you want. I'll search for SPYM, which is currently trading at around $80 per share. I'll click Buy, choose Market Order, which means I'm buying at the current price and it goes through immediately, double-check everything, and hit Submit. That's it. First investment made in under 5 minutes. 3 rules to stay on track. Now that you're invested, here are the 3 things I'd tell my younger self to keep doing. 1. Automate your investing. You've probably heard the phrase, pay yourself first. This is exactly that. Think of yourself as a small business. You earn income, you cover your expenses, and you pay your employees. Your future self is one of those employees, and their salary is whatever you invest each month. Set up a recurring automatic transfer so it happens without you having to think about it. Willpower runs out, automation doesn't. 2. Don't sell when the market drops. This one is hard, but it's critical. Look at what happened in 2020. The pandemic hit, the market tanked, and it looked scary. A lot of people panicked and sold, thinking they were protecting themselves. But if they'd held on, they would have watched the market not only recover, but hit new all-time highs within a couple of years. ETFs are specifically designed to ride out downturns because when one company struggles, the other hundreds in the fund balance it out. Dips are temporary. Long-term growth is the pattern. 3. Stop trying to time the market. There's a bit of investing lore around something called the Costanza strategy, named after the Seinfeld character who does the opposite of his every instinct. Research has actually shown that even investors who bought in at the worst possible times, right before a crash, still came out ahead over the long term. The market rewards patience and consistency, not perfect timing. Nobody can predict what happens next week or next year. What you can control is whether you keep investing month after month, regardless of what the headlines say.
Before you invest, 2 things first. Now, here's something I want to be upfront about. Even though I believe investing is important, there are 2 situations where I'd actually tell you to hold off before putting money in the market. The first is high-interest debt. Say you put your wedding on a credit card, and now you owe $5,000 at a 23% interest rate. Every month, on top of paying down that balance, you're paying around $95 just in interest, a fee for having borrowed that money. And that fee doesn't stop until the debt is gone. The longer you carry it, the more it costs you. To me, high-interest debt is like driving home with a slow puncture in your tire. You can keep stopping to pump it up, but you're still leaking, still being slowed down. Pay it off first. The second is not having an emergency fund.
When you invest, the whole point is to leave that money alone for 5, 10, even 20 plus years. But life happens. Your laptop dies, your car breaks down, you have an unexpected medical bill. If you don't have a cushion, you end up pulling money out of your investments, which means losing out on long-term growth and potentially paying taxes on it too. I recommend having 3 to 6 months of living expenses sitting in a high-yield savings account. It keeps pace with inflation, and you can access it quickly when you actually need it. Unlike investments where it can take a couple of days for cash to clear, a high-yield savings account is ready when you are. So, before you invest a single dollar, pay off high-interest debt and build that emergency fund. Once both boxes are checked, you're ready. How much do you actually need to start? Here's the good news. You don't need $1,200 to get started. You don't need $500. You don't even need $100. Most platforms today let you start with as little as $1. But I do want to give you a sense of what consistency over time actually looks like. If you invested just $1 a month for 40 years at a 10% average annual return, you'd end up with about $5,300. Raise that to $10 a month, and you're looking at $53,000. And if you can get to $1,000 a month, that compounds to roughly $5.3 million. The amount matters less than the habit. Start with whatever you have, and as your income grows, increase it. The important thing is to start.
If you follow everything I've walked you through today, you'll start investing earlier and more effectively than I ever did. And honestly, if I could go back, I'd have been far more aggressive from the start. But since I can't rewind, I'm just glad I can share what I've learned and hopefully save you a few years of trial and error. If you want to go even deeper, if you want me to walk you through every step live and help you actually make your first investment as a complete beginner, I'm hosting an investing masterclass, and the link is in the description. Whether it's today or tomorrow, come join us. And if you got value from this video, leave a comment, hit subscribe, and I'll see you in the next one.